Hey everyone, welcome back to your weekly market outlook. This is for the 1st to the 5th of May 2023. So we have basically just jumping into the 5th month of 2023, and just a few things to talk about. Let's take a quick recap on last week. It might not seem like there's much going on last week, but last week was pretty much a very important week if you're a yen trader. So we'll take a look at the Aussie CPI first. So we have the CPI numbers falling for the Australian economy here. The year-on-year CPI dropped down from 6.8% to 6.3%. Quarterly CPI down from 1.9 to 1.4%. 3-month CPI, the core CPI for the quarter, down 1.7 to 1.2%. Now we also have it just came in at time of recording, the updates coming out from the RBA that the RBA just actually hiked interest rate by another 25 basis points, but we'll discuss about that later once we talk about what's going on this week. But that's for last week. I've got the advanced GDP numbers for the US economy. It is pretty low, 2.6 to 1.1%. The only good thing that happened on the release of this data is that the US economy is not the US economy. The banking sector was pretty much there was an issue with First Republic, and for those that didn't know, First Republic actually took over some of the accounts from the SVB. So but in doing so, the quarterly reports, they actually have 100 billion deposit outflow coming out for the quarter for this year, and it kind of leads to the current situation where the First Republic themselves are basically taken in by regulators, and then some of the accounts auction off, and we already have that information this week. Last week, market was pretty much panicking on whether or not the banking sector has it recovered, has it not recovered. So there's a little bit of a flow towards safe haven to the US dollar and the Japanese yen. Obviously, a little bit goes to the gold, but nothing much. Pretty much a lot of them are pretty much concentrated into the US dollar. So it kind of kept the US dollar afloat, even though with the lower GDP numbers coming out from the US. But so that's basically what happened last week. So it might cause a little bit of confusion. The GDP numbers was really low. What's going on? There was other factors actually in play as well. And then comes Friday, we have the Bank of Japan monetary policy meeting, right? And this is basically the first meeting for the new governor Ueda, and there were concerns about whether or not the Bank of Japan is actually going to start tightening their monetary policy. That doesn't seem to be the case. There's no tweak to the YCC. The JGB bond yield cap was basically kept unchanged at 50 basis points. A little bit of word changes in the forward guidance, but nothing really major. Really kind of in fact they kind of signals out that the Bank of Japan is actually pretty much concerned that the inflation might not reach their target, that the inflation for 2025 is actually going to drop down to 1.6%. So they're actually going to keep their monetary policy a little bit looser, because in comparison to other economy, the Japanese economy is slightly different. They've always had close to 0% interest rate. In fact, right now it is negative interest rate since the 90s, and that seems to be the ongoing case, that the country is kind of like in a state of disinflation. So the current situation where the inflation got pushed up, it's kind of a little bit beneficial for their sake. So with that announcement coming out from the Bank of Japan, obviously the market saw it in a different angle. If we take a look at some of the interest rate differentials between the FOMC, the ECB, Bank of Japan, FOMC, ECB, they continue hiking interest rates. Bank of Japan is not doing anything, so it kind of adds on into the carry trade fuel, and it really smashes the Japanese yen on Friday last week. So we have significant gains for the market. In fact, pairs like the euro yen, it kind of surpasses the 2014 high, 2015 high, and it's basically now at the 2008 level for the euro Japanese yen. Sterling yen, it's still there. We still have a little bit of a reference point to a certain degree, but once those key levels are taken out, we basically need to refer to 2008 highs, and that's how big an impact on the market for the yen pairs or yen crosses last week, just on the back of the Bank of Japan decision to kind of keep and signals out that they're likely going to keep the monetary policy still, ultra easy going forward. Okay, so that's basically the key takeaway for last week. And then we have the core PCE numbers from the US. Again, it's not going to change much. We are expecting the FOMC to actually hike interest rate this week as well. All right, so for this week, we've got data's coming out on Monday with the ISM manufacturing PMI. This one here was a little bit higher, 46.3 all the way up to 47.1, still below 50, but this is kind of a good surprise to the upside. It kind of boosted the US dollar a little bit overnight, but again, the surprise was basically today with the RBA just announcing that they actually bumped up the interest rate to 3.85%, up 25 basis points. This really surprises the market, because the market was actually pricing in that the RBA might actually stay put and pause until July or August, or at least going to the third quarter of 2023. That's not to be the case though. RBA surprises the market, hiking 25 basis points. And if we take a look at the statement that they have, it's that the word some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame, but that will depend upon how the economy and inflation evolve. So it's going to be data dependent going forward, but this is a strong wording coming out from the RBA. Pausing the interest rate hike last month to assess the market, and then pretty much everyone in the market kind of anticipated that the RBA is not going to do anything until July, August this year. But they surprises the market and mentioned that inflation, even though it's coming down, it's still pretty high, and they want to be ahead of price curve instead of lagging behind the curve. Not sure if this is going to signal any significant continuation to the interest rate hike next month, or they might pause again next month, but it is a very strong wording coming up from the statement that we can see the Australian dollar really rally up today just on the back of this. But yeah, some further tightening of monetary policy may be required. This is a strong word coming out from the RBA, considering that they paused last month. They were looking a little bit more dovish. This time around, they seem to be looking at the inflation going down and say, hey, you know what, we are actually ahead of the curve, let's stay ahead of the curve, and that's curbing inflation at the risk of potentially not having a soft landing for the Australian economy. So they're really pushing it to the limit at this point in time. So that's another consideration for the RBA, but again, that's likely going to be for next month in terms of the consideration. All right, so apart from the RBA, obviously we have the JOLTS job opening numbers today. At time of recording, this is going to be on Tuesday. JOLTS job opening numbers was key last month because it fell down below 10 million for the first time in a very long time, and the anticipated number for tonight, it's actually going to be a little bit lower as well, 9.93 to 9.74 million for the JOLTS job opening numbers. And then tomorrow, for Wednesday, we have the ISM services PMI as well as the ADP and FP numbers. Not really too concerned about the ISM services PMI. It has stayed above 50, and it's likely going to stay above 50. We've got the flash services PMI still really high anyway, so not really too much of a concern. The concern was actually more on the manufacturing side, and we have actually seen improvement with the data that came out last night. Okay, next on Wednesday is actually going to be Wednesday, but depending on where you are, if you're in Australia, this will be Thursday for you. The FOMC statement, the FOMC is expected to hike by 25 basis points. I don't think we're actually going to be looking at a pause here from the FOMC. This point is high. I don't think the FOMC is going to surprise the market by pausing pausing the interest rate hike. I think they're still going to go ahead with that 25 basis points. That's going to take the interest rate from 5% to 5.25%. Now, 5.25%, it's their interest rate target from their economic projections. So that's kind of the limit. That's kind of the ceiling at this point in time for the FOMC. All right. Also to note, for this week, the Asian market might be a little bit quiet, and it might get a little bit volatile as well. The Chinese market and the Japanese market is actually with a Golden Week holiday, so it's basically going to be a very quiet Asian market anyway. Following FOMC, we've got the ECB. ECB is also expected to hike 25 basis points. From 3.5% to 3.75%. But to note here, today on Tuesday, there's actually going to be that flash CPI numbers coming out from the Eurozone. The expectation is a jump from 6.9% to 7.7%. If we see a number higher than 7%, for example 7.2 or 7.3%, then the ECB might actually still consider a potential 50 basis points hike. So in terms of whether the FOMC or the ECB is going to be the key mover in the market, I think both are going to be key movers in the market. But typically with the ECB, it's not really too much of a concern. But this time around, we need to be a little bit more cautious, because if we take a look at the stance from central banks around the world, we've got a surprise 50 basis points hike from the RBA and Z last month, with the RBA expected to pause, and instead we get a 25 basis points hike. The consideration for a 50 basis points from the ECB, this is actually discussed, and the message was actually sent out by ECB voting members that could be in consideration. It's on the table, right? So the potential for a surprise 50 basis points shouldn't be ignored for the ECB policy statement on Thursday. All right, obviously the key points would come in from the press conference. That's 30 minutes after the rate statement release. Also, don't forget, for this week we also have the employment numbers coming out from the US. The NFP is expected to drop below 200,000. I think this is going to be the first expected drop below 200,000 for quite a couple of months. But again, the expected drop is from 236,000 to 180,000. It is a huge drop. If we see a number higher than 200,000 at this point in time, that could be a good sign for the US economy. But if it goes below 180,000, if it misses the consensus, let's say it might come in a little bit lower at 150,000, that's going to be really negative for the US economy. But in all honesty, considering the current situation, the US dollar might actually be the beneficiary for this if we get a bad number for the NFP. So it might actually be kind of flip, right? You might think that the NFP numbers is bad, the US dollar should be bad. There is a potential concern where the market might think the US economy is really in a bad shape, and that could be a potential towards a run to safe haven. This could actually boost the US dollar instead of dropping, acting as a negative trigger for the US dollar. So we don't know how the market is going to react on the NFP release this Friday. So this one here is a little bit unique because in terms of interest rate hikes, we kind of projected, market is expecting a 25 basis points hike, and this 25 basis points is going to take the FOMC to their terminal rate pretty much at 5.25%. So post that, this is going to be unique, right? We don't know whether it's going to be good news or bad news. It could both be beneficial for the US dollar at this point in time. We're just not sure really in terms of whether or not the NFP with a negative number could impact the US dollar negatively, because there's always that concern. The market might take that as it's kind of a signal that, hey, the economy is not doing that great. The FOMC is over tightening. The banking sector is in crisis over there. So they might actually look at this and consider that as a potential for more of a safe haven rally, and that could boost the US dollar itself. Okay. Other than that, the average hourly earnings expected to remain the same at 0.3%. The unemployment rate expected to bump up a little bit higher, 3.5% to 3.6%. All right, so let's take a look at the dollar index here. Now, if you take a look at the dollar index here, we are surpassing that 102 level. This is actually on the back of the dollar yen strengthening. We will discuss the dollar yen next because we need to take a look at the dollar yen in terms of the context of stuff. But yeah, the dollar index is pretty well supported. We've got that reversal around 180. This is back above 101.50, 102 at time of recording. This is back above 102. No signs of slowing down yet. Still looking a little bit choppy, but in terms of support, yeah, we definitely have 101.50 at this point in time as a key support. Now let's talk about the dollar Japanese yen, because with the dollar Japanese yen, if we take a look at the movement on the US dollar last week, it was kind of a little bit pressured on the pound USD and the euro USD. So the US dollar was actually weaker against the euro and the pound last Friday, but the dollar Japanese yen, back on the Bank of Japan decision, that rallies up. It takes out that 134.50, a level that we've been monitoring, and as I previously said, a break above 134.50 will lead to 137 without much resistance, and that's basically the case. It's actually now approaching 138 for the dollar Japanese yen, and this one here definitely need to keep a close eye on 138, because once we break 138, we actually don't have a lot of resistance until about 142. Beyond 142, then it's kind of creeping up again. 145, 146, 148, it just adds up, right? But if we take a look at the current situation here, what's capping the market since December last year, it's that 138 level. Once that 138 level is taken out, then yeah, we might actually see a potential grind back towards 150. And remember that 150 level is the level that where the Ministry of Finance in Japan actually intervenes in the currency market and kind of start buying the Japanese yen at around 150 level. All right, but that's pretty much it for the dollar Japanese yen. Overall, I think this one here, just on the back of what the Bank of Japan is saying right now, I think 138, it's a pretty critical level to watch out for. Once a break above 138, then we actually don't see a lot of resistance to about 142. In terms of support, obviously previous resistance level at 134.50 and 135, that's going to be your immediate support level, so it's kind of huge. So if you're thinking of opening up a new positions on the dollar Japanese yen, just keep in mind the volatility, it's pretty high on the yen crosses. In terms of opening out a new position, you might actually be looking at about 100 to about 200 pips in terms of stop loss at the very least. All right. Okay, so we have the Aussie USD here. So we have that bounce from 66 cents technically, right? We got support at 65.50. This week started below the pivot level. Again, what the RBA does was pretty much a surprise to the market. So this one takes the pair up a little bit higher, but overall, for the Aussie USD, we're still not in the clear. For the Aussie USD, it is still below the Ichimoku cloud. We are basically approaching the Ichimoku cloud. We still have 67.50 as a resistance to keep in mind, and then beyond that, we've got 68 cents for the Aussie USD. So might look like a strong boost at this point in time, but we're not confident with the current move. Is it going to be strong enough to actually take the Aussie USD back up above 68 cents in an instance, or at the very least this week? So we're still going to go by with the weekly pivots that we have, so keep an eye out on resistance 2 at about 67.50, 67.60 to about 68.20, which is a resistance 3. That's likely going to be the range for the Aussie USD this week. All right. Next is the Euro USD. We're kind of looking at an ascending triangle at 1.105. Overnight though, because of that stronger PMI numbers, ISM manufacturing numbers, ISM manufacturing PMI numbers from the US, it kind of pushes this one down a little bit lower. Now, It's not really kind of game over for the Euro USD. It is still well supported. Technically, the underlying trend still points to the upside. We've got 1.105 as a key resistance. In terms of support, we've got 1.0950, 1.09, 1.0850. These three levels are going to provide a lot of significant support for the Euro USD. But again, you know, for position traders, I think we need to clear off that hurdle at 1.105. Once we clear off 1.105, then that's where we are likely going to see the Euro USD track higher, potentially towards 1.1175 and 1.12 on the Euro USD. For the Pound USD, this one here is a little bit stronger. Overall, it is still borderlining at that 1.25 level, but if we take a look at the momentum here, we still have a lot of room to go for the Pound USD. Again, we need to see that close back above the daily pivot at the very least, which is a daily close above 1.251, right? Once we have that daily close back above 1.2510, then that's where we would anticipate further move to the upside. We're looking at a move towards, at the very least, 1.2625, which is the 127.2% Fibonacci retracement. Beyond that, we don't actually have a lot of resistance until about 1.28. In terms of immediate support for the Pound USD, you're going to be looking at about 1.24 and 1.23 as your key levels. I don't expect the Pound USD to drop down all the way to 1.23. So really, realistically speaking, I think we're looking at support coming in at 1.24 to 1.2450 for the Pound USD. The overall tone for this one here is still bullish. All right, and last one, we have the oil here. Oil overnight, it's not really overnight, but oil has been dropping down significantly, and then, you know, the overnight drop in oil, that was on the back of a lower manufacturing numbers coming out from China, and also the current state of the US economy that kind of helps come into play with pushing oil prices down. But as previously mentioned, we are looking at demands to come in pretty much at the mid 70s here, you know, and then support to come in at about 72, 73. We basically got that, and we still have demands coming in for oil at this point in time. It is not considered oversold as of yet. We needed stochastics to move back up above 20, but the overall condition for US oil at this point in time is that this is still above the Ichimoku cloud. We still see buyers coming in at these prices. It is considered to be a cheap price as it gets closer to 70 for oil. So with oil, I think we could actually pause for a little bit here, wait a couple of days. It might transition and signal an oversold condition once the stochastics moves up above 20. That's where we're likely going to see a lot more buyers coming into the market. So we got a couple of pointers here. At least what we're looking at, 76.50, 77 cents. You know, if price manages to kind of move back above 77 cents, then that's where we are likely to see oil pushing up a little bit higher. If you're thinking of going short oil at this point in time, do keep in mind the current retracement is about 50%, so this is about kind of the normal range of retracement. Wouldn't want to go too much short on oil. I think we're still looking at demands, and technically speaking, we're just at about 50% retracement. We're still above the Ichimoku cloud. You know, we still got demands coming into the market, so I think the best case scenario is actually to wait for price to move back up above 77 cents if you're thinking of you know, holding on a long position for oil. But if you want to scale in into any long positions that you have on oil, right now is actually not a bad price. We're not really getting kind of the best price at this point in time, but you know, we're working on an estimated range at about 75 to 77 cents. That's where we expect buyers to come in for oil. Okay, with that, good luck for your trades for this week, and I will see you next week.